Everyone do Charts and Chats with me, Gordon Scott, and we're going to talk about which stock to trade now because that's what we always talk about on a Monday morning. But we're going to do it from the lens of what's happening with oil. You might think you know what's driving oil prices right now, but there might be a bigger picture worth looking at so that you could get ready for some important opportunities which are going to come along in the next 2 months worth of trading. And we'll look at what those are, how to take advantage of them, and how to protect your risk while doing so. So let me see if I can share my screen and start off with a chart that is worth looking at. This, it's important to know that the US stock market is not open right now. Normally, this is the moment it would be opening and trading away, but it's a bank holiday in the US. However, it's not a bank holiday for the futures markets. So today is a great day for us to be watching what the futures markets are doing and being prepared for the next week to see where the opportunities lie. We don't always know just by looking at, the weekend or overnight or, the Globex futures market, what's going to happen in the stock market. But we can get an idea of the bias there, whether it's bullish or bearish, and then prepare ourselves looking for opportunities as the market opens up tomorrow at about the same time. All right, so what I've got right here is two prices. One is the price of light sweet crude oil futures, and that is, looks like that's off the Italian. So that's not the right one. There we go. That's the right one. All right. Now this one here is like 15 minutes delayed or something. But if I take it down to 5 minutes, let's see. That should be the current time, right? Yeah. So yeah, that's 15 minutes behind the current times. You can see it's changing. It's still trading. So futures markets that trade 24/7, like oil, like stock indexes, like gold, they're still running right now. And if this is now a 5-minute chart, if I look at where we got started, which was, let's see, this is 18th. Here we go. Here's the weekend. So this is Friday's close. This is Sunday's open. And we jumped up. That's an important thing, just that little gap. The very first thing people did when they could trade again was buy. Huge sell-off since then, or immediately after. But since then, trending steadily higher. And right now we're almost where we were, just functionally where we were at the close. So it's kind of flat. Big up, big down, and trending higher. Now, to me, I would say that's a bullish bias. Not that, it's strongly bullish or anything. It's true that it just is pretty much the same, pretty much flat. Why would I say that's a bullish bias? Well, because oil was already high to begin with, and yet people wanted to come in here and buy it. They wanted to buy it. First off, they got it taken to them, and then they came back from that and decided to buy more. So I just feel like there's the bias to push prices higher embedded in this last several hours worth of trading. And that's not a big surprise considering the whole Russia-Ukraine thing, right? Latest headlines were, hey, Russian invasion could come any minute, says U.S. White House officials, and Russia's like, what? But no, invasion of Ukraine? No, we don't have any plans for that. All right, except over the weekend, I'm sure that you may have seen something like this. If you haven't, it's really worth having a look at it. I saw a map somebody just showed in one of the news things about where the troops are in in Russia or in Ukraine. And I don't know if we can find a current one here. Possible Russian invasion of Ukraine. This is how it would happen. Okay. This was somebody's scenario that they would put troops all around and then they would, try and invade like that. But where the troops actually are right now, Reddit. Yeah, I think this is pretty close to what I saw, whether it's accurate or not. So you see, the capital of the country. Let's go ahead and look at this if we can. Yeah, it's not that great of a map, but it'll do. And the question I'm really interested in is I can see where Kiev is. Well, my guess is it's right there, but that looks like it's in written in acrylic. Yeah, let's do it. Let's do it this way. Yeah, and I've spelled that right. Oh, well, I think I did. I got it right. Okay, so this is Kiev. And okay, the Kiev further back. What we were looking at was they have troops from here, and of course, all around here in the Crimea, and I think just about up to there is all they have. Well, I guess that is actually Ukraine. So let's go back to how far do they have it? Oh no, they do have something clear out there on that. In Romania or Moldova, somewhere in there. Okay, so as you can see, they don't have it, all the way out to here, or they don't have anything in Poland or Hungary. Of course, these are NATO countries, so they're not going to be able to do that. And I don't even know that they need to go here, but generally speaking, it's like you look at all those troops around the outside of the border of Russia or border of Ukraine. If all of these troops were to push in and then to try to defend this line right here, or even right there, or whatever, right? That's a lot smaller surface area than all of this, right? If you're playing that old board game Risk, where you move people around, if you're just playing a game and you're looking at this map and you say, I got a bunch of armies around here and they got some armies in there, and I'm going to lose a bunch of armies, but when it's all said and done, with what armies I have left, all I'm going to have to defend is this. That looks like a pretty good bet. That looks like a worthwhile try, right? So I don't know what Russia has to gain by deploying as many troops as they have, the way they have, if all they're going to do is turn around and say, oh, this was just a big misunderstanding. We're going to go ahead and pull back right now here. You're going to send those payments, right? I mean, it's like, they have some sort of arrangement. I don't see it. So to me, it looks like an invasion is very much in the planning. Even though the Putin administration says, but we don't have anything planned. No, I'm just the deployment, so anyway, why is that important? Well, because that's what's driving oil. That is what is driving oil prices higher. That's why oil has a bullish bias, because people look at that information, they look at that data and they say, oh yeah, an invasion is going to happen. In fact, this invasion the probability of this invasion has been being priced in ever since December, and it just keeps going higher and higher as the invasion becomes more and more probable in people's minds, in investors' minds. Here's something else. This down here is the volatility index for oil. Sorry. Okay. This is the same thing as the VIX compared to what the VIX is to the S&P 500, OVX is to the price of oil. It usually has a negative correlation, an inverse correlation to the price of oil. Oil goes up, this thing goes down. This thing goes up, oil goes down, right? So let's look closely here. At this point, because of the scale of this thing, we can't really see exactly what the trend was, but we don't have to. What we're going to do is line these things up from this point. Whoops. So that they are, aligned, right? Okay. So the price of oil makes this huge drop around Black Friday, right after Thanksgiving in the US. At that particular time, news was breaking about the impact of the Omicron variant. And people thought, oh man, we're going to have to go back into shutdowns. The economy is going to be hurt. Demand is going to decrease. Price of oil is going to fall. And so that's what got priced in, right? But very quickly, people realized Omicron was a nothing burger. And shortly after that, the movement of the troops in Russia became the news. And so if I go here to middle of January, we come back here like this to the same spot, then we see the opposite trend. So this runs up, the volatility runs up, the price runs down. Then volatility decreases while the price increases. Everything is as you would expect. The weird stuff starts happening from the middle of January going forward. What we have here is a classic divergence. And notice that this divergence, it looks really subtle compared to, where it's been before. But I think that it's important not to understate this. Okay, so we have this price movement, which is continuing. It's the same as this. If the OVX, the volatility index for oil, is doing the same thing, I mean, if the price of oil is doing the same thing in two segments, and then the OVX should be doing the same thing in two segments, but all of a sudden, no, in the second segment, oil starts doing something different. Why is that? Well, it might be because oil's volatility floor is just kind of where we are. But I think it's more than that. See, clear back here in August, this is coronavirus, right? I mean, once people started settling down and started returning back into the markets, oil volatility dropped. I mean, oil volatility was so high because of all that oversupply of oil. But then once the oil market started moving again, then this is the floor. And you see, this is how low volatility can go. Here, we spiked down, but just one little dip. Other than that, we're not anywhere near that line at all. If there's no big deal, if prices are just going higher, we should be at least hugging this floor support level, let alone making excursions into it, going just a little bit lower, kind of like what happened here in just the past summer. But that's not what's happened. Instead, we get this run up here. And oh, by the way, that level, that price level in OVX, 58. How often do we hit 58 going back? There's one big spike, another big spike, and this, November timeframe of 2 years. Well, I mean, 2020. It's rare. Here we've spiked up to that level um, almost 3 times, very close to 3 times. So nowhere in this area did we spike that high. And even at this level, we didn't spike that high. Getting up into the level where we've spiked 3 times in this past little bit been something rare. So I think the fact that we're not hugging the bottom line and the fact that we are spiking up these highs at levels which are more elevated says that I mean, this isn't a big surprise. Of course, if Russia's going to invade, then things are going to become more volatile. The problem that I'm seeing is OVX isn't just occasionally running up, it is trending up. You've got this thing going up, you've got that thing coming down, and look at these green candles right through there, continuing strength. This came to a head here just these past few days, and all of a sudden oil prices started coming down. This day right here, and the day in front of it, that is the period of time where oil inventories were reported. Oil inventories came in 20% higher than expected. There was a lot of extra oil in storage. And so people who knew about that were rightly concerned, but and started to sell it down. But buyers came right in with Russia, and up we go, right? If Russia weren't in the picture right now, where would the price of oil be? What I'm trying to point out is I think it would be 20% lower, somewhere around 70-ish down here. That's a big fall if all of a sudden oil were to start dropping and heading down to that line. As long as the headlines are about Russia doing something in Ukraine, it's probably not going to drop that far. But if for some reason diplomacy works its way through here and we don't have armed conflict, we don't have tanks shelling continuously at one place or another. If instead what we have is a little bit of an armed conflict and some news and scary looking headlines, and then a day or two all of a sudden treaty papers are signed and all sorts of things happen diplomatically, well, it won't take long, but that's where oil will go. It'll head right down. Now, I think what will happen though once that kicks in is that shortly after that, the demand for travel in the US will spike and head back up. There are a lot more people working from home, not only in the US, but in other countries as well, but certainly in the US. A lot of people working from home. And when you work from home and you're a road warrior, you could go anywhere. You could go on vacation and take your work with you and just say, I'm going to take a half day today and maybe take tomorrow off. And then I'll be back in the next Monday. And maybe I'll take a half day on Monday. All of a sudden now you got this 5-day stretch where you don't really have to do a lot of heavy work. And you can go take a vacation with that period of time. Another situation is, a national holiday. You just build it around and add on a couple of extra days. And there's all sorts of people who are freelancers, right? They're not expected to punch a clock, regardless of whether they're remote or not. And a freelancer, they can spend their time doing whatever, wherever. So the ability to travel is greatly increased over the past 18 months or so. And the way people's work expectations are set, that the ability to travel is greatly increased. And so I think that is going to lead to increased amounts of desire to travel and sightsee and go out and do things with a greater sense of freedom. The mask mandates are beginning to end. All sorts of states are planning to lift their mask mandates entirely by March, April at the latest. Many of them are already underway as states in the United States. So that's just going to create a whole lot of spring fever. People are going to say, oh, okay, now let's start making our plans. And so I think what will probably happen is, if the Russian Ukraine thing doesn't, turn into just a war and just become bad, right? If somehow there's this back and forth that makes people feel like, oh, they're not really going to have a big old war, then we'll see oil drop down. But the demand for travel in the U.S. will turn right around and push um, that price of oil back up. So I think there's some really good moves. I mean, hey, if you knew that this was going to do this back in November, you really could have made out big on oil. I think we've got two similar situations. We got a big down move and a big up move uh, potentially coming in the next month or two. So keep an eye out for that. See, the thing is, oil has already broken its trend. That's the key thing to understand. You look at this downward or this upward trend, yeah, there's that excursion, but pretty much the rest of it is there. It's broken, right? We come up here, the market opens tomorrow and it runs up, hits, turns around and starts coming down a little. That's your signal. See, I mean, Russian invasion, we should already be making new highs today. We're not. We're just sort of lollygagging around and maybe going down, and uh, and so people will want to buy on Tuesday. They will want to push prices up. Some will. The question is, will there be more that want to push it down because they're taking profits from all of this run up or whatever reason, or because they see their own, stores of oil too large and they got to reduce prices to, you know, unleash capacity and so forth. So watch closely as prices come up. If they find some resistance and they start trending back down, that's your signal. Could be a big downward move. And how would you take advantage of that? Well, the very easiest way to do so is with this stock right here, SCO. SCO, just think of it as short crude oil. That's not what it stands for, but just imagine and then you get the idea. So in other words, if oil prices are dropping, this thing's going to go up. In fact, it's a leveraged ETF. So if oil goes down by 1%, this goes up by 2%. If oil goes down by a 20% drop, this thing's going to go up to a 40% gain from wherever it is. Right here, we're at about $9. If let's say oil just drops 10%, then this is going to go up by 20% up into this range, $11. And you might think, well, wait a second, it was way up here. Why wouldn't it go, retrace this? That's the sort of pricing issue with leveraged ETFs. You're on a continuous downward slope. It's like trading the VIX. You're never going to get yourself back up to these super high levels. See back here, it did this reverse split 1 for 4, right? At some point in the future, the same thing will happen. But now what you're looking for is, that's why you got to kind of measure yourself in your expectations for using SCO. If in fact oil goes up by 10%, this thing should go up 20% over that same period of time that oil drops. If oil drops 20%, this goes up 40%, right? Best case, wildest case scenario would be SCO ends up here. So, a $9 stock trying to go to 11, 12, 13, 14, somewhere in that range, depending on how strong the drop in oil prices is. I don't think there's going to be a huge oil drop, but SCO making it up into the 11s, I think is very probable over the course of about a month. So that's one way. That's if you're doing stock, you don't want to go short, you don't want to do futures, you don't want to do anything crazy, right? That would be the easiest way to trade the downward move in oil. And then what about if you wanted to ride it back up? Let's see, UCO, I thought it was TCO, it's UCO. If you want to ride it back up, then this would be the one you come after. If oil drops then UCO is going to drop as well. But if oil rises, this is going to rise at double the rate. If oil goes up 1%, this goes up 2%. So you ride SCO going up until you feel like gold has bottomed out. I mean, oil has bottomed out. And then when you feel like oil is going to turn back around, then you jump into this one. So there are two big opportunities. Of course, if you feel like, no, Gordon, you're crazy, this whole thing, it's going to turn into war and it's going to be bad, well, then you already know what to do. Oil is just going to keep going higher and you're just going to go get oil stocks. The easiest of which is ExxonMobil. But ExxonMobil's already kind of playing out my scenario. Look at this. See, big, strong run up, but it's been going down for a longer period of time than the price of oil has. EGY is almost, penny stock, right? And it had this big run up, and now it's had this big drop, right? So that big drop, that tells you, like ExxonMobil, something is probably afoot. It's not a given that we're just going up, 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 and up. Meanwhile, that's really an interesting oil stock to be looking at. And then there's anything that's in the energy arena. Gold miners ETF, that's not the right one. REI, that's what I'm after, Ring Energy. Okay, so this one looks similar in upward trend, but gotten a little weaker lately, but notice it hasn't come down. So this is a penny stock where if in fact Russia invades and it's all bad and there's lots of demand for oil and shortages and so forth, then you're going to see this one go higher and EGY go higher and ExxonMobil go higher and all the other oil stocks. So that's where you would go. I'm seeing specific weakness in the price of oil right now and strength in the oil volatility index that doesn't lend itself to making for a good play, a good plan to just buy oil and hang on. I think could be looking at oil making a significant drop in the near future. And so you want to keep an eye on how to take advantage of that. All right. With that being said, I'll be back here next week looking at the price of gold and seeing what we can get from that commodities movements and what we can expect in the months to come. Until next time, everyone, take care and trade well.